Hi there, welcome to Kneppy Invest. Time for another portfolio and technical update. In today's video, we're going to look at the performance of my three portfolios using different strategies, and then we'll look at some charts. It was a busy day investing wise for me, not work wise, although I did a Queensland North shift, which means I was producing aviation forecasts for Queensland North. And that means I was doing the Cairns Airport TAF, that sort of thing. And I was actually working the day where Tropical Cyclone Jasper made landfall. And I've maintained an interest in that area because it looked like the Cairns and surrounding areas were going to be really wet days after Jasper made landfall. And I just noticed overnight a mountain of rain hit that area. I was looking just south of Cairns. Some locations had over 500 millimeters. It's not hard to see why a lot of the rivers and creeks in that area are now at major flooding. So 24-hour rainfall, we've got above 100 millimeters from around about the Ingham area all the way to Cooktown and then even inland areas. So that area of Australia is getting absolutely pummeled because Jasper is barely moving, very slowly moving to the west. And if we just have a look at the updated Cairns radar, it's just still getting pummeled. In fact, Innisfail's had 48 millimeters in the last hour, and Cairns 37 millimeters in the last hour. So keep safe if you are in that area of the country. So even though we are in El Nino, doesn't mean it's going to be dry everywhere, because we can get these rogue events which can produce prodigious amounts of rain. In fact, when I did go for my shift, I said it's not going to be the wind that's going to be the main danger with this system. It was going to be the rain because of how slow Jasper was going to be moving, particularly when it went inland. But this is not a meteorology or a weather channel. This is a forecast. Well, I won't say forecasting channel. This is an investing channel. So when we do look at some charts, I'll be focusing on some companies that are looking interesting right now. Oh, I should also mention that I ordered some investing related products a few weeks ago. So I bought some Step 1 underwear. This was during the Black Friday sales. So we are talking about 2 weeks ago. It took a long time to get here. Got a few apologies from Step 1. I don't blame them. I blame more Australia Post because Australia Post had the package for the longest time. And the reason I bought some underwear is because I just wanted to test the quality of these underwears. Now, durability is going to take a fair bit of time, but I just want to test the comfort. And not only test the comfort, I wanted to see if I could run in these underwears. And right now, I bought 7 pairs. I've already worn it. I'm wearing my fourth pair or third pair right now. And I can tell you right now, and this is what other people have told me, once you buy some Step 1 underwear, you're not going to wear anything else. Now, my mum bought me some bamboo underwear about 5 years ago, and they're my favorite underwear. And I think these underwear will replace those. And I can't see myself wearing any other underwear. Now, I am not being paid by Step 1. This is just me doing some research in regards to a product of a company. Now, just because I love these underwear doesn't mean everyone else will. And that is something you have to be aware of as an investor, that you don't want your buyers to swayed or I won't say swayed. Is that a word? Sway your decision making. But this is a good sign. Plus, I have heard other people say this as well, that they only buy Step 1 underwear right now, and they are expensive, and that's why I use the Black Friday sales. I bought 7 pairs at 40% off. So a really good exercise in testing a company's product. So if they can manage the current management team, manage the company well, and if they can market the Step 1 underwear, I think this is a company that can definitely move places. And they're expanding. I saw that day are now selling women underwear as well. And maybe that could expand even further. The other thing I made or purchased during the week is some books. Now, I did get a question, what are some really good technical books or technical analysis books? And I gave my opinion, but some of the books I did recommend are books I read a long time ago, and I did not read the hard copies. I read online copies where I could not make notes. So I decided to buy 3 books. One of the books is coming from Amazon Germany, and that won't arrive until probably 2 more weeks. I probably would guess between Christmas and New Year's, but 2 of the books did arrive. I did get an apology from Amazon because it arrived instead of the next day, it arrived 2 days later, and they did apologize. I don't really care about that. The first book is Technical Analysis and Technical Analysis of the Financial Markets by John J. Murphy. I read this many, many years ago, so it's going to be interesting to see if I can take anything else away from reading this book again. More than likely, because my knowledge base has increased significantly, I might take way more out of it. The other book I did buy, and I read this online, quite a few years ago. It's probably my favorite. And if you asked anyone who is a chartist, they probably would say this is the Bible for technical analysis. This book was first published, I was going to say 1930s, but I think it was 1950 something. First published, because one of the authors of this book was born in 1893, Robert Edwards. The other author is John McGee. This is the 11th edition, first published, I want to say the 1950s. I have a guess. I'm just going to have a look. There's a lot of prefaces to this. So there's a preface for all. So this book is a memorial for John McGee, who's one of the authors of the original book, who died in 1987. So that shows you how old this book is, 11th edition, and this book is Technical Analysis of Stock Trends. The Bible, some would say, of technical analysis. And I am going to take notes, read a lot of pages in this book. So I didn't realize how big this book is. Over 600 pages long, but some of that is the prefaces and that sort of thing. There's also a nice little, I didn't realize this, there's a nice little, what do you call it, glossary? Not glossary, yeah, glossary. Definitions of all the words. So accumulation is the first definition. No, first definition is EN. Whatever, no. Well, that's addition. First real word in the glossary is accumulation. The first phase of a bull market. So what I might do is go through these books, take some notes. If you want me to do, say, a video on the chapters of this book, I will be very happy to do that, because in a previous life, well, actually in this life, because I don't believe in reincarnation, I have been a tutor. I've been a teacher at a university. And one of the best things about being a tutor and a teacher is when you are teaching, you learn a lot, because you have to know a lot about what you are teaching. And if I actually have to do videos on these books, say a topic in these books, more than likely I'll come away from preparing for that video much better prepared. So there is a benefit to teaching or tutoring. So those are the purchases I made during the week. Well, actually, they weren't purchases I made during the week. I received those purchases during the week, and I'm really looking forward to going through those two books and the other book I'll be receiving in a few weeks' time. Now, on to the performance of my three portfolios, starting with the quality portfolio. This is just the traditional investing approach where you buy high-quality companies for the long term. This is how I started investing back in 2000, was it 2009 or 2010? I can't quite remember right now. Back then, I was looking for high-quality companies that were good value. And back then, there was a plethora of them. In fact, I bought Commonwealth Bank and BHP first. Those are two companies I bought first. More than likely, I would not buy those now. Well, not more than likely. I'll definitely not buy those companies now and put those into this portfolio. However, quality portfolio up 6.9% compared to the benchmark, which is the STW, at 5.72%. Ideally, I want to at least double the benchmark returns. Well, maybe not. Yeah, ideally, but at least I want to beat the benchmark returns, because if I can't, I just may as well put all my money into the benchmark or ETFs and do other stuff with my time. However, I do like investing, do like going through this process. I think one of the reasons why the benchmark and the STW or the ASX 200 had a good week is because of banks, and BHP, Rio all had really good weeks. I was really surprised to see some of those charts. In fact, I think the P ratio of Commonwealth Bank now is about 20, which is absolutely ridiculous for a company whose management have even stated they're not going to grow. P ratio of 20 for a company that's not going to grow is absolutely insane. That's just my opinion. I can buy companies that are going to grow significantly over the next 5 to 10 years at P ratios less than 20. You don't talk. I'm not going to talk about Woolworths, which is even more ridiculous than CBA. Anyway, so I won't go into details about how these companies have performed because I've already talked a lot about my purchases of the books and underwear. Now onto the small cap portfolio. So this is looking at mostly profitable small caps. Now, my definition of small caps is a little bit different than the professional or the technical definition of small caps. When I say small caps, I'm talking about companies with a market cap, probably less than 200, 300 million. There are some companies here with a market cap above $1 billion, but they are few and far between. When you are talking about the technical definition of small caps, people talk about Flight Center, corporate travel management, Nick Scali, companies like that. And I get a little bit annoyed when I read an article about these are the small cap companies to buy, and they're talking about companies with a market cap above $1 billion. I like smaller companies. I like companies that have the potential to grow significantly over the next 5 to 10 years. Sure, there are some companies that won't grow like that, but the main point is buying a nice big basket of those sort of companies. And I have a pretty big basket. We're talking about probably 40 companies, maybe even more than that. I wish I showed you how many companies I own. Anyway, so the small caps over the past few years have performed pretty badly, and I am using a benchmark called the small ords benchmark. And if you look at the small ords and what make up the small ords, some of those companies are pretty big, and I would not include those companies in this portfolio. But small cap portfolio up 14% since the start of the financial year compared to the benchmark, the XSO, which is only up 2.34%. Although the XSO did have a really good week, it rallied really strong. And the best performing companies in this portfolio are still Atlas Pearls and Findy. Surprise Findy is still around, or just above $1.03. I think that's really good value. So probably also should mention the makeup of my quality portfolio is not going to change all that much. On occasion, I will make a purchase or a disposal, but I don't think I made a purchase in that portfolio for over a month, maybe even 2 months. And again, just like the quality portfolio, I am going to be not that active in the small cap portfolio. On occasion, I will sell companies. On occasion, I will buy some companies, but largely, I do like the makeup of this particular portfolio. There is one company I have been thinking about selling, and that is Gentrack. I'll put that into the technical part of the video. I've been thinking about taking profits in that company completely, up 60.6%. I think there is a possibility that company now has reached really full value. It's rallied a lot over the past year, up from about $1.50 to $6, so a four bagger during that time. Now there is potential it could go further from here, but I'm willing to take profits in that company because it's run much further than I thought it would. So there is some potential I might sell some of these companies and take profits. Atlas Pearls is another one that's run really hard. More than likely I'll keep Findy for a while. And then the final portfolio is my technical analysis, technical portfolio, we'll call it, because it is called that. So this is where I've made some purchases and disposals during the week. So I'll talk about that in a second when we look at the technical update. And one of the reasons why I've decided to spend a little more time reading books is because this portfolio is performing really well. I am doing a pretty good job, even though I keep making mistakes. And I am learning from these mistakes. I'm doing a checklist of what I want to look for, that sort of thing. And at this point in time, this technical portfolio is up 22.5%, up really nicely from last week, compared to the benchmark, only up 5.72%. So I'm beating the benchmark by more than 4 times. That's exactly what I want to see. I'll talk about, again, the disposals and purchases I've made during the week in the next section, the technical update. But if we just look at what I'm holding right now, my open positions, the best performing company is Step One. So one of the reasons why I wanted to test the underpants was because I have Step One in this portfolio, and I wanted to question, is this or does this company belong in my small cap portfolio? And that's the big question I have. Really nice dividend yield from when I purchased, so 13.5% dividend. That's another thing you can't dismiss. Other companies that have done really well, Collins Food, and I am thinking of taking profits on that company, up 21.3%. So it's hit my target range in terms of return. So my target range is between 20 and 30%. So you notice that step one is well above that. And I'm willing to run my winners, but I'm also willing to take profits in these bigger companies. Dicker Data is at 18.75%. Stream Service or Service Stream at 17.2. I'm just waiting for that company to get into the 20% range so I can sell Service Stream. And I was going to give it away, what I purchased. Mass Group up 11.1%, James Hardie at 10.7%. And the only company, apart from Bravura, which is steady from when I bought, literally steady. I bought it at 80 cents. It's still 80 cents. The only company that is in a loss right now in this portfolio is a massive mistake I made, and that's Vista Group. And the main reason that's a massive mistake is because it's how illiquid that company is. And one of the rules I'm going to have is in this portfolio, companies can't be illiquidly traded. I don't mind having companies illiquidly traded in my small caps because, to be honest with you, that's a longer term hold. In this case, I want to get out of Vista Group simply because it's so illiquidly traded, down 10.55%. I have put a sell bid into the system at $1.50. So if it sells at $1.50, who knows, it could hit tomorrow or even the next day because it is quite volatile, the share price. If it does sell, I can sell this at $1.50. I actually would sell it at a profit. Anyway, so even the companies I'm still holding up 15% from when I bought. Okay, so that's all I'm going to talk about in regards to the performance of my portfolios. Now I'm going to look at a technical update. Before I look at the purchases and disposals I've made, I'll just focus on some interesting charts. I already discussed the XJO briefly in a video that was titled Go Market Go. So I won't discuss that anymore, but it is heading towards a resistance zone. So that resistance zone is really between about 7,450 and around about 7,600, and it's at 7,442. Should I look at the XSO? Yeah, XSO looks okay. Still hasn't broken out. This is not an uptrend yet with the XSO. NASDAQ, Dow Jones is at a record high. I actually will feature the Russell 2000. This is interesting. So this is Dow Jones right now, beautiful looking chart. But the Russell 2000 is interesting. So this is the smallest 2,000 companies within the Russell 3000. So this is like a small cap proxy, and really nice rally in the Russell 2000 since the end of October, which was a low. At that point in time, it was looking fairly bearish, but it hit a support zone. Look at that. Technical analysis does work. I really like resistance and support. And the reason that worked is if you go back to June of 2022, in October 2022, Russell 2000 struggled to go below that area, and it struggled to go below that area in October this year. And then it rallied all the way up to 2000. And what happens at 2000? Last three times Russell 2000 has got to this level, it's pulled back. So that happened in August 2022, in February 2023, and in July 2023. So even though it's rallying really nicely, we've seen this story play out. So we want to see the Russell 2000 to get above 2020 on strength, some good volume coming in, that sort of thing. Won't talk about Dow Jones, won't talk about gold. So remember, it's actually really interesting because some of the podcasts I listen to are about a week and a half in delay, including AusBiz The Core. And if you go back to AusBiz The Core last week, like Monday, Tuesday, I was so bullish, so much enthusiasm about gold and gold companies. And I talked about gold breaking out. And I just wanted to bug in. I wanted to go back in time and tell them the gold breaking out was a false breakout. I think someone actually did mention that in one of the episodes. It looked like it was breaking out, but it failed. And gold has now gone back below that old, maybe not old, but still that resistance zone at 2060. It looked like it was breaking out. It failed. And now it's at 2020. Won't look at iron ore, uranium, oil. Well, actually, I will look at oil because I did make a purchase during the week. I'll talk about that in a second. I was thinking maybe oil has reached a bottom. It's only a potential bottom right now. Definitely, if it goes down to about $65, I would look that at a bottom, definitely a bottom. And I would be more interested in taking positions in oil companies at that point in time. But there is also a potential to go below $65. But because oil is manipulated by OPEC, I don't think it has much to fall from here. However, in saying that, if economies really struggle moving forward, then that will negatively affect the oil market. Won't talk about lithium, it's still going down. Haven't looked at copper. Copper is actually looking better. And iron ore, not iron ore, coal. Still no. And Bitcoin. Nothing wrong with Bitcoin right now. Still, it looks like a beautiful chart. Probably the other really interesting charts is bonds. So this is a 30-year bond. It is down. It's gone from 5% to 4%. So it is down 20% in about just under 2 months. So yeah, so this is one of the reasons why some of the equity markets have gone on a run is because bond yields are going down, and I think the market is now overreacting, particularly because it's pricing in 5 rate cuts. The Fed making 5 rate cuts in the next year. I think that could be an overreaction. Okay, so that's all I've got in regards to indexes. Apparently, you can say indices or indexes, so I will interchange between the two. So that's all I got in regards to indexes, commodities, Bitcoin, and bonds. Now on to individual companies. And first of all, I'm going to go through some of the purchases I made and disposals, and then we'll look at some interesting charts and stories. Starting with the reject shop. So I bought this company a while ago, and it's doing nothing. So I sold this at a small loss. I did get a dividend, but it's really doing nothing. Even last week, it's just done nothing. So I just decided the potential. So I like this company because what was happening from about July into August looked like the uptrend was starting, but and I thought the story was good that if people are having financial difficulties, more than likely they're going to shop at the reject shop. But maybe they don't. Maybe they completely ignore the reject shop. It's interesting. So I went past the reject shop, and there wasn't many people in there. Then I went past Chemist Warehouse because of that merger with Sigma Healthcare, and there was a massive amount of people in Chemist Warehouse. I just could not believe how many. I've never been in a Chemist Warehouse store before. I just could not believe how many people were in a Chemist Warehouse. And I did this maybe 10 years ago, comparing Dick Smith to JB Hi-Fi, and the difference was stark. And that's one of the reasons why I was convinced that Dick Smith stores were not going to make it, and they did not make it. Now, I'm not saying reject shop stores won't make it. They probably have low margins, and they probably don't spend much on cost, that sort of thing. But because of low margins, I don't necessarily think this is a company you want to own for the long term. But Chemist Warehouse, just the amount of people in those stores was just mind-blowing, in my opinion. I can definitely see why they are successful. And I'll do a standalone video. I did get a question about Sigma Healthcare and how the share price did rally when they started trading again, which was absolutely insane. I'll do a short standalone video on that because there was a question in my Go Market Go video. So I've sold reject shop, which is okay. And that's the whole point of this strategy is if the reasons you buy into a company aren't really playing out how you envisage, just sell it and find another company. And that will become important in a second. Now, the company I bought and sold in the 1 week is PeopleIn. So I bought it at 99 cents and I sold it at $1.19, I think it was. So a nice little around about 20% gain. And that's all I wanted. I didn't expect more. I thought it was oversold. And I thought just based on the volume as it hit the bottom, massive increase in volume, hit the bottom. And on that bottom, that day with the massive amount of volume, that was a bottom in the share price. I have seen this time and time and time again. When you see really big volume coming in, it can highlight a potential bottom. Not always. It's not 100% accurate, but it's pretty high. And the rally in PeopleIn share price was such that I just took 20% profit. That's all I want. The other thing I noticed is each day the profit decreased. That's another sign that the market is getting a little bit less enthusiastic about PeopleIn as the share price rallies. So this could be a little bit of a dead cat bounce. So wouldn't be surprised to see the share price reach a top right about now and then the share price start falling again. Now, a company I did buy, this could be a controversial buy in this portfolio, technical analysis, is Zip. Now, Zip was one of a few companies I could have bought, and I decided to buy Zip. It was a low conviction buy because of how volatile the share price has been. But the volume is what drove me into this and just a changing sentiment. Bought it at 55 cents and it's already 63 cents. So already up almost, yeah, it's actually more than 10%. Bought it at 55, so 60, yeah, almost over 10%. I did not buy many shares simply because it's low conviction, but the volume. And the other main thing here is on the up days, the volume is much higher than on the down days. So what you do is look at these green volume bars So when the share price of this company rose 25%, that was on really big volume. The next day, share price rose another 3%, really good volume. But on the down days, really low volume. That is telling me that there is less selling pressure than buying pressure, and there's more enthusiasm about this company. So this is definitely sort of a change in sentiment in regards to economies. If future rates start going down, this is one of the companies that might benefit. And there's other stories I read that a lot of people are now using buy now, pay later because they are under financial stress. Now, that medium term, that might not benefit Zip because of bad debts, that sort of thing. But this chart is starting to look really good. And another thing I'm not hesitant about doing is if this trade really works out, won't be hesitant about adding to my position in this particular trade. Another company I bought during the week was Karoon. Share price has fallen a lot. I thought there was a nice little support level at around about $1.90, that sort of level. Some really good volume coming in the last few weeks. So this was a technical play. Hit a nice little support zone, and the share price of this company has bounced. Now, again, the share price of this company is going to be highly influenced by the price of oil, and I think oil is near a bottom. Doesn't mean it can't fall further from here, but I will not be surprised to see oil go up from here, maybe for a few months, and that would mean that would be beneficial for Karoon Energy. And I do think the market's sort of overreacted when it came to that particular purchase and that capital raising. And I'm pretty sure the price of Karoon right now is a fair bit below the capital raising price. I think that was at $2.10. I might be mistaken. So I think I bought $1.90 or $1.95, something like that. So that's going good. Now, when it comes to buy now, pay later, we have a few companies on the ASX, not as much as many we did before, but there is one company on the NASDAQ, which is Affirm. Look at this chart. So today was the first time I had seen this chart. I went, whoa, the sentiment of this company has completely changed. This is a beautiful looking chart right now. Share price of this company has quadrupled since May. So we're talking about a 6-month period where the share price has actually more than quadrupled. And in the past month or so, the share price has just taken off. Now, I don't want to go heavy into buy now, pay later, but if you look at the longer term chart, this is definitely a turnaround story and a technical or possible technical trade. So Affirm, market cap still $13 billion. And there was a few other, actually I'll show you Splitit. So I was interested to look at some of the other buy now, pay later players on the ASX, and a few of them aren't moving at all. Thumb's not moving. Sezzle barely moved at all. There might be a few others, but Splitit is just like Zip and just like Affirm. We are starting to see movement, not only movement, we started to see increased interest, increased volume. So this is another potential play. It says market cap 28 million. That seems a fairly low. So Splitit, yeah, put that onto your radar, and possibly even Sezzle, because those share prices haven't moved. It could be just delayed, and you might see movement in those share prices in the next few weeks. So I got a little bit ahead of myself there. Let's go back to Doug. This is a really important, I was going to say story. This is a really important, we'll just go with story. Really important lesson. That's a better word, lesson. So a few weeks ago, there was an announcement from Doug that the wife of the CEO or the founder or someone was selling us a fairly big chunk of shares. If I remember correctly, it was because of taxation reasons. Now, a lot of retail investors get really nervous when they see someone like that selling shares, and they will sell without question. And that's exactly what happened on, it was the 30th of November. Share price of Doug fell below $1.60 because of that nervousness and wariness. I was, in fact, thinking about buying or adding to my position in this company, and the share price has increased from $1.60 to almost $2. So that concern didn't last very long. So don't get caught up when you do see significant holders selling. It does not mean there's something wrong with the company. It does not necessarily mean they have seen something that they have not told us. Now, there is a caveat around this, and this is around if, say, 5 or 6 directors or management sell shares at the same time, and they are selling a fair few shares, that can be a sign. Research has shown this, and I do have a perfect example of that. A2 Milk, a few years ago, when the share price was like $17, $18, the directors sold en masse, and the share price fell from $17, $18 all the way to $4. And just after they sold, like a month after, they released their very first downgrade. So look when a group of directors or management sell en masse, not when just one of them sells, because of tax reasons. So they're saying is insiders sell for numerous reasons. It could be they want to buy a yacht, or they want to buy a really big house, a mansion, but they only buy for one reason. They think the company is undervalued. Anyway, so that's an important lesson for Doug. Don't be nervous, wary when an insider sells some shares. Oh, Neuren. I always say Neuren Pharmaceuticals. I've talked about this company a lot in the past, and this company went to a trading halt in regards to phase 2 results. I did go to Hot Copper just to see the mood. There were a few holders thinking it's going to be bad news because they went into a trading halt. I would probably say different based off what the share price did the previous day. Share price of this company rallied 6.5% on okay volume, and could be a sign of I won't say insider trading because that's really negative. A sign that someone's enthusiastic about these results. A really nice looking chart for Neuren Pharmaceuticals. This is a company I'm going to own possibly forever. There's no reason for me to sell this company because I bought shares in this company many years ago at a share price, was it $3? I've taken some profits along the way. I wish I didn't at this point in time, but at this point in time, there's no reason for me to sell because I have made massive amounts of money with Neuren Pharmaceuticals. And not a mistake I made, but a lesson learned for me. So a company I have featured in a few of my technical updates video in the past has been Cobram Estate Olives. Was starting to look really interesting. There was a nice little resistance level at $1.42. It broke through it on the 7th of December, and I was thinking of taking a position in this company at $1.50. I actually put in a bid at $1.48, just being sneaky. And maybe I should not be sneaky in the past. If I want to buy a company, 2 cents does not make a difference. In fact, I was thinking that at the time. Do I really want to save 2 cents per share when I could just buy $1.50? And then the company released a pretty good update and the share price has just taken off and now at $1.68. So technically I lost 10%. 10%. But this chart is looking beautiful. Look at that. Beautiful chart. Long-term downtrend when this company listed. So there could be way more to run. And I'm not an expert on olives, but apparently they are moving into their ideal olive season or seasons because the maturity of trees takes a while and they're right at the exact part of the cycle where you want to be. Maybe that's why the share price of this company is starting to run. Because if you look at the price earnings ratio, 90.45, wow, why would you buy this company? But there could be a scenario where the profits of this company triple or quadruple in 1 year just because of a shift in the cycle they're in. So a lesson learned from me, don't become cute. Don't think you could save a little bit of money by buying at 2 cents cheaper. I actually have done this. I've done that quite often in the past. Another company I do like, probably for the longer term, is MA Financial Group. And it does look like the share price of this company has broken out. I'm going to call it. It broke out again on the 11th of December. I'm going to call it. And this looks pretty good. Pretty good, MA Financial. So why did it break out? Look at last 2 times it tried to get above $5.50. It failed back in February and July of this year. And now it's starting to look good. The last time the share price was this high for this company was way back in August of 2022. So we are talking about more than 1 year high for MA Financial. Another company I've been following, I do own this company, and this company I believe is in my quality portfolio. Now there is questions whether Dominos Pizzas is a quality company. I understand that. But this chart is starting to look better. Now, it was starting to look pretty good in January of this year. You can see the share price rallying, and then the company released a really disappointing report in February. But this is starting to look better than back there. Share price was consolidating for a while. Share price took off on Thursday, and the last time the share price was this high was February this year. So not quite a 1 year high, but definitely an 8-9 month high in Domino's Pizza. So this is starting to look better. And on the flip side, so over the past 5 months, even longer than that, insurance companies have been the place to be because of rising interest rates. They can pass off those costs to their holders, premium holders, whatever you want to call it, their insurance people. And this has been the talk of the town. I have not had one insurance company in my portfolio. That could have been a mistake, but now we're starting to see weakness in all of the insurance companies because they benefited from a rising interest rate environment. So apparently they're going to, and the other reason why they benefit from a rising interest rate environment is because they put all their premiums into investments, that sort of thing. Maybe they don't, but they do benefit from having higher interest on all their premiums, and those benefits are going away if it's straightforward. And that's why, if you look at the charts of these insurance companies, I've got QBE here, but you look at IAG, what's the other one? IAG or Suncorp Group, all of those charts are starting to show a little bit of weakness. So share price of QBE down to $14.20. It was as high as $16.20 at the end of October when we did see sort of the overall weakness in the market, overall less enthusiasm about inflation being controlled and interest rates falling in 2024. That's when insurance companies reach their high. So there is a relationship between the two. So I'd not be in insurance companies right now, particularly if you think interest rates are going to fall. On the flip side, and one of the reasons why we saw a really good few weeks in the equity markets in Australia is because banks ran hard. I was shocked to see this. So I don't hold Commonwealth Bank right now, but Commonwealth Bank has ran from $96 to $110, which may not seem a lot, but that is pretty significant increase in share price for a company like Commonwealth Bank, which is not growing. Management have already said that. They're not going to grow. They actually said in their financial year presentation or commentary that instead of growth, they're more secure and safe, which for some reason they think that's a good thing. For me, it's not a good thing. I want to see growth. Anyway, the reason I've included Commonwealth Bank in this particular video is because look where the share price is right now, $110. If we go to the weekly chart for Commonwealth Bank, so it's almost a record high. The last 2 or 3 times the share price of this company tries to get above $110, it's struggled. So this could be the top for Commonwealth Bank. Now, if we do see a breakout, I still won't buy this company because the P/E ratio of Commonwealth Bank is nearly 20, which is ridiculous for a company that is not growing. I think I've already said that. So Commonwealth Bank is at a nice little resistance zone at $110. I've already talked about Splitit. So let's go to a couple of other companies. So CSR, I've included just because I went through the charts before this video, and this one looks pretty good. CSR says the price earnings ratio 14.7, dividend yield 5.4, a nice chart, nice upward trend in the share price. And for some reason, the share price of this company has rallied the last week from $5.90 to $6.46. And the last time the share price was this high, you have a look at the weekly chart, may have been never. I know it would have been, yep. The last time the share price was this high, CSR, was way back in 2008. So we're talking about a 14-year high in CSR share price. Now, the other reason I wanted to include CSR is if you go back in time to the weekly chart, you can see back in 2021 and 2022, share price of CSR really struggled at these levels. So you can just see got to these levels once in May 2021 and then pulled back. It tested again in November 2021 and then pulled back. It tried to test it again in March 2022 and then really pulled back. And possibly this is a breakout. Share price has just got above these levels, but I remain, because this was a really good week. CSR share price went up 9% in the week. So it'll be interesting to see where CSR share price moves from here. This could be a breakout for CSR. 14-year high in the share price. Can't believe that. And even the financials don't look too stretched. And finally, Gentrack. So I have been thinking about selling this company. The other one, actually, I'll include Collins Food because more than likely I will take profits with Collins Food and then look for other opportunities. So first with Gentrack. So this is a weekly chart for Gentrack. So back in 2019, 2020, share price of this company fell a fair bit. In fact, in 2018, share price of this company reached a high of $6.80. Share price fell all the way down to a low of 80 cents. Then the share price went sideways for a long period of time. I bought shares in this company back in 2021 at $1.20 or something like that, just waiting for it to break out. Share price broke out in November 2022. So 1 year ago, share price of this company broke out just above $2. Share price has tripled from there to $6.14. Not only that, in 2 or 3 weeks ago, when they released their results, I think it was their results, share price rallied 27% in 1 week. I'm just thinking the market is getting a little bit too ahead of itself. Not only that, if you go back to the weekly chart, Share price is now getting up to those levels we saw back in 2018. So I don't know. No, I'm free carrying shares in this company right now because I've taken profits. So I don't know. I'm undecided about this company. Maybe I should just let technicals make my decision for me. And if I just use technicals to make the decision for me, I probably would not sell this company. However, share price did go on a really good run. You could say it's overbought, but since the share price, after that run, the share price has just gone sideways, which is actually a good sign. There's not a lot of sellers out there. Some nice volume coming in the last trading day of the week. Anyway, and the last company I'm going to look at is Collins Food. Actually, for some reason, I put where I bought. Probably should do that for all my technical trades, is where I bought. So I bought it at $10.02. Share price now to $12, so 20% gain. So 21% gain if I include dividends. I'm not bullish on this company at all. They did release a pretty good report. That's why the share price has rallied, or trading update, why the share price has rallied. Last time the share price was this high was, you have to look at the weekly chart. Last time the share price was this high was back in start of 2022. So if you do look at the weekly chart from 2023 all the way through to 2021, this was a really bullish weekly chart, apart from the COVID-19 financial panic. So maybe I'm overthinking this. But again, this is not the company I'll probably own for the long term. And my aim was just 20% for this company. So more than likely, I'm trying to talk myself out of it, but I'm not going to talk myself out of it because I have rules. And this is a sort of company where I'm just going to take my 20% profit and sell more than likely on Monday, unless the share price falls significantly on open. Anyway, so that's all I got for this portfolio and technical update. If you have any questions about what am I doing, anything I've mentioned in today's video, leave those in the comment section of this video. Otherwise, I'm not a financial advisor, so if you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for the video. Have a good day. Bye.